Happy Friday, everyone. Sabrina Fox, founder of Fox Legal Training. I wanted to come on and give you a little rundown of 3 key flexibilities that Lottomatica has attained following its successful pricing of its bond offering this week. I'm going to share my screen and just demonstrate quickly how you can tell that the borrower did not have any changes to their covenants. So if you just scroll down, there are going to be lots of things in terms of pricing. And here we have amendments to the preliminary offering memorandum. They will always amend the summary financial information because this will be updated for the cash interest expense or any kind of coupon that has been discovered through pricing, and a few other changes related to that, which are all kind of incorporated here. And as there is nothing else listed here, we can tell that there were no other changes to the terms. So the 3 key points I wanted to make are in respect of, first, the blended make-whole language. So what I have here is the black line compared to the borrower's deal that they were taking out, so the bonds that are being refinanced. And this is something that was also added to Federagoni's deal last week as compared to the deal that they were refinancing, and which did not appear in the January deal. So this may be something that we end up seeing more frequently. And what this basically means is that the borrower can use the make-whole and equity clause together. So if they needed to take out the bonds in the case of an LBO or some other transaction that they couldn't do under the covenants because of lack of flexibility, then they could use the equity clause to take out 40% of the aggregate principal amount of the notes at par plus the coupon, and then they could take out the rest with the make-whole substantially concurrently, which overrides this requirement that at least 50% of the aggregate principal amount of the notes remain outstanding, which is a standard requirement of the equity clause. The next one, and I wanted to point this out because I think we might see this in deals going forwards, and this language is, if you know what to look for, it's easy to find, especially if you're looking at a black line. So we recommend that folks keep an eye out for that. The other thing I wanted to highlight, and obviously lots of things in here that I highlighted for purposes of the primary market education series, this entire highlighted OM is available on that platform, and that's free for buy side and journalists. So if you'd like to get in touch to get access, let me know. The second point is this uncapped repurchases of management, employee, and also now operating advisor and consultant equity. So if these individuals were to receive equity of the borrower or any parent, and this includes employees, directors, officers, managers, and now operating advisors, consultants, etc., this could be repurchased by the borrower, and there is now no cap on the amount that can be repurchased. So if operating advisors could be interpreted to be, for example, a private equity sponsor giving advice on operations, then perhaps this clause will allow them to repurchase any equity held by them on an uncapped basis if it's under one of these management or employee or benefit or stock option schemes. So something else to keep an eye on, uncapped baskets are always something that I want to flag for people. And then the last one was on calculation mechanics. So there were lots of different things added to calculation mechanics, but I wanted to highlight 2 things. One was the removal of the EBITDA adjustment, which you can see here has been crossed out. So sorry, EBITDA adjustment add back cap. So there was a 25% cap on EBITDA adjustments and add backs for cost savings, operating expense reductions, and synergies. Now they've added restructuring charges, operating improvements, revenue increases, revenue enhancements, expenses, synergies, and other adjustments, similar initiatives, or effects of synergies. So lots of other aspects or transactions and features permitted to be considered in respect of these add backs, plus new or revised contracts and new projects, which is a defined term. And then no cap on that now, and then a few more EBITDA add backs added toward the end here, as you can see, P, Q, R, and S. So these are additional add backs the borrower is permitted to take into consideration to add back to EBITDA, and as I mentioned, now no cap on that. And then the working capital debt has been carved out from all of the ratios. So EBITDA could potentially be higher, debt could potentially be lower because of the exclusion of working capital debt. And there's also an uncapped working capital debt basket now in the debt covenant as well. So debt consisting of local lines of credit et cetera, or other operating facilities, either incurred to finance the working capital needs of the issuer and its subsidiaries. And as you can see, there's no cap there, or this kind of cap basket for other local facilities. So those were the points I wanted to share today. There were, as you can see, lots of other highlights and changes reflected. All of those you can see on the Fox Legal Training platform. Just get in touch if you don't have a login. As I said, it's free for buy side and press to look at the primary market education series. I'm using these deals as an opportunity to teach market participants how to analyze covenants quickly, easily, efficiently, accurately. If you would like to get in touch to find out more, I'm at sabrina@foxlegaltraining.com, and I would love to hear from you. Happy Friday, everyone. Have a wonderful weekend. I hope you found that helpful, and I will be back next week reviewing a deal live during webinar style format on Tuesday morning at 8 a.m. I hope to see you there.